All right, Megan, should we go ahead and get started? Are you ready?
Yep, go ahead.
Okay, thank you. All right, well, hello everyone. I think we're ready to go ahead and get started. Thank you all for joining us today. My name is Kristen Stang. I'm the president of CCIM for 2021, and we are excited to have you here with us. So really quickly before we get started, I wanted to remind everyone a little bit about CCIM and some of the great programming, events, and education that we have available for you. CCIM is a community of professionals. We provide content and connections in the commercial real estate industry. We are an international network and we offer excellent education courses and topics specific to commercial real estate. So these include courses such as development, investment analysis, construction, partnership structures, negotiations, and market analysis. Please check out these websites here on the screen. We've got our local website on here and the National CCIM Network website. You can sign up for scholarships for these courses through our local website, and you can sign up for the actual classes themselves on the national site. So please check those out. Next, I would like to remind everyone of our upcoming events that we have. On April 8th, we will be touring the new Sycamore apartment project that was recently completed in Delano. We'll have drinks, appetizers, and we'll be there from 4 to 6 o'clock. So we hope to see you there. We're excited to see that project. Following this event, we will have a sneak peek tour of the new baseball stadium downtown before the new season kicks off. More details of this will be announced soon, so watch your emails for that. And finally, I want to take a moment to thank our sponsors. Their contributions are what allows us to host these events and deliver this valuable information to you all. So please take some time to review this list that's on the screen. As you are out working in your business, please rely on these partners as a resource for getting your deal done. We have really, really great professionals in our market, and we want to make sure we're utilizing all of the resources that Wichita has to offer. And so now I'd like to segue into our event today. We're excited to be hosting our sponsor, BKD, and we're excited to talk about the latest changes and updates to tax law concerning individuals, businesses, and real estate owners. Obviously, as real estate professionals, this is an important topic for us to be up to date on, and so we're really excited to learn more. And next, I would like to introduce Laura Barnes with BKD. Laura is our 2021 treasurer for CCIM and has been a great addition to our team. So Laura's going to talk a little bit about the event today and also introduce our speakers. So with that, Laura, I will pass it on to you.
Awesome. Thanks, Kristen. Okay, so just a quick little bit about BKD. We are a national CPA and advisory firm with, we have 40 offices in 18 states across the United States. We can provide standard accounting services like audits and tax work and outsourced accounting, but we also specialize in risk management, technology, wealth management, and valuation services. So if any of those spike your interest, be sure to reach out to us. We do have a great deal of expertise in our Wichita office, but we are fortunate that we have many colleagues across the country that we can reach out to for special circumstances if we need to. So just want to introduce Matt and Maggie to you. Matt is a member of BKD's National Construction and Real Estate Group. He has more than 23 years of experience providing tax compliance and consulting to corporations with complex structures, as well as individuals. He advises clients on real estate, cost segregation strategies, research and development tax credits, like-kind exchanges, and then other federal, state, and local tax credits. So he is a member of the American Institute of CPAs, Kansas Society of CPAs, Kansas Associated General Contractors, and the CCIM Institute. He's currently serving on the board of Wichita Chapter of Construction Financial Management Association, and he also holds the Certified Construction Industry Financial Professional designation. So he did graduate from University of Kansas with his business degree in administration and accounting. All right, so now Maggie, she is also a member of BKD's National Construction and Real Estate Group and provides tax and consulting services to a variety of entity types with an emphasis in partnerships and S corporations. Maggie works directly with clients to facilitate and prepare federal and state income tax returns. And she provides some tax planning and tax saving strategies as well. Let's see, she also assists clients in navigating new and complex tax laws, which we've definitely experienced a lot of over the last few years with all the tax reform that we've had. So she's also a member of the American Institute of CPAs, Kansas Society of CPAs, and she's also a member of Women in Commercial Real Estate. She is a graduate of the University of Illinois at Urbana-Champaign with a bachelor's degree and a master's degree in accountancy. Okay, so we are doing a Q&A session at the end, so feel free to leave some questions in the chat as Matt and Maggie are doing their presentation, and we will try to answer as many of those as we can at the end. All right, with that, I will turn it over to Maggie to get started.
Okay, thank you, Laura, and thank you, Kristen and the CCIM group for asking Matt and I to present today. I think we have some pretty interesting topics to go over, so hopefully we can get everybody on this call excited about some tax updates. So our agenda for today, we'll talk about some of President Biden's key tax proposals for businesses and individuals. We'll provide a legislative update and dive into the newest stimulus bill that was recently passed. And finally, discuss some overall business and industry-specific updates. So before we dive into our agenda, I'm sure you've all heard that the IRS has extended the filing deadline to May 17th. This is an automatic 1-month extension that applies to individuals only. So calendar year C corporations and trusts that are also due on April 15th have not been extended at this time. Also important to note that this extension is only for filing and payment of 2020 taxes. So those first quarter estimates for 2021 are still due on April 15th. Several states have already announced that they are conforming to this federal extension to May 17th, and Kansas is one of those states. So now we will jump into some of Biden's key tax proposals. So individual tax rates. We currently have 7 tax brackets, with the top rate being 37%. Biden is proposing to raise just one rate, the highest tax rate, from 37% to 39.6%. Only taxpayers with income over $400,000 would be affected by this change. Our current tax law also has an individual alternative minimum tax, or AMT, and Biden has not proposed any changes to AMT for individuals at this point. Our current law has preferential rates for long-term capital gains and qualified dividends. These are taxed at a maximum rate of 20%, though most taxpayers actually pay a 15% rate, with those in the 2 lowest brackets actually paying a 0% rate on long-term capital gains. Biden is proposing to increase the tax rate from 20% to the ordinary rate of 39.6% for taxpayers earning more than $1 million a year. For taxpayers earning less than $1 million, he is not proposing any changes to these rates. So the 20, 15, and 10% rates would still apply. So let's jump into some individual deductions. So taxpayers are currently entitled to deduct the greater of the standard deduction or the sum of the itemized deduction. So these are things like mortgage interest, medical expenses, state and local income taxes, property taxes, and charitable contributions. So while certain itemized deductions are subject to a limit, for example, the deduction for state and local income taxes and property taxes combined is capped at $10,000, there is currently no overall limitation on itemized deduction. So Biden is proposing a couple changes to itemized deductions. First, for those earning in excess of $400,000, he would reinstate the P's limitation. This is the provision that was eliminated by TICJA. It reduces a taxpayer's total itemized deductions for 3% for every dollar that exceeds $400,000. Biden would also limit the overall benefit of itemized deductions to 28% for individuals with income greater than $400,000. And as mentioned, state income taxes and property taxes combined are currently capped at $10,000, and Biden is proposing to eliminate that cap. The Social Security payroll tax currently applies to wages up to $137,700 in 2020. Once wages exceed this amount, the Social Security tax is no longer applied to wages above this amount. Biden is planning to lift the cap on the Social Security tax on wages above $400,000, which would essentially create a donut hole. So, for example, an employee who is paid a $500,000 salary would pay the 6.2% Social Security tax on the first $137,700 of wages. No Social Security tax on wages from $137,000 to $400,000 of wages, but the Social Security tax would kick in once again on wages above $400,000. One of the most significant changes that Biden is proposing is to drop the lifetime exemption back to normalized amounts. So the lifetime exemption is essentially the maximum amount of money that you can gift in your lifetime without paying tax. The exemption is currently $11.7 million for single filers or $23.4 million for married couples. Biden is proposing to reduce these amounts to $5 million or as low as $3.5 million for single filers prior to 2025 when the current provision was set to expire. Taxpayers currently get a step up in basis on inherited property to the fair market value. Biden is proposing to repeal the step up in basis and instead replace this with a carryover in basis. So now we will look at a few of the business related provisions. Biden is proposing to increase the corporate tax rate from 21% to 28%. He would also like to reinstate an alternative minimum tax for C corporations that was repealed by TICJA, but it would be a 15% minimum tax on book net income in excess of $100 million. He also wants to phase out the 199A qualified business income deduction for taxable incomes over $400,000. So like-kind exchanges and qualified opportunity zones are two incentives that allow us the opportunity to defer capital gains. Biden is proposing to eliminate the use of like-kind exchanges altogether for taxpayers with taxable income over $400,000. Qualified opportunity zones will get to stick around. Biden is planning to incentivize QOZs to partner with community organizations. He would require that benefits be reviewed by the Department of Treasury, and he also wants to introduce transparency by requiring detailed reporting on the impact on local residents. TICJA gave us enhanced bonus depreciation and expanded Section 179 amounts for capital recovery. Bonus depreciation is currently at 100% and is set to begin phasing out in 2023. For net operating losses, the CARES Act suspended the 80% limitation for 2018 through 2020 tax years. So in these years, we have the ability to offset 100% of taxable income with net operating losses. Also, for NOLs generated in 2018 through 2020, we can once again carry these back for up to 5 years. So Biden is proposing to reverse both of these provisions related to accelerated depreciation and net operating losses. So now we will switch gears and provide a little legislative update specifically related to the most recent stimulus bill. So the American Rescue Plan Act of 2021 was signed into law just 2 weeks ago on March 11th. This is a $1.9 trillion COVID stimulus bill. It includes aids for vaccines and testing, aid for state and local governments, rental assistance, and aid for multiple different industries. It also includes tax-related provisions designed to benefit both individuals and businesses, and that is, of course, what we are going to talk about today. So let's jump into some provisions for individuals. So ARPA includes another round of recovery rebate checks, $1,400 for an individual or $2,800 for joint filers, and $1,400 for each qualifying dependent. The first 2 rounds of checks only applied to dependents under the age of 17, but this third round actually expands it to include full-time students under the age of 24 and adult dependents. These payments are subject to a much quicker income phase out. So payments begin phasing out once income reaches $75,000 for single filers or $150,000 for married filers. And they're fully phased out once income reaches $80,000 for single filers or $160,000 for married filers. For those who have already filed your 2020 tax return, payments will be based off of 2020 income. If you haven't yet filed your 2020 tax return, the IRS will use your 2019 tax return information. That means if you're at or near the phase out threshold, it's important to consider the timing of your filing. So for example, if you are a single taxpayer whose 2019 income was $70,000 and your 2020 income increased to $80,000, you should wait to file your 2020 tax return until you receive your recovery rebate check. There's no option to go back and optimize the payment based on 2019 income if you've already filed your 2020 tax return. These payments will be reconciled on your 2021 income tax returns. So if you are eligible for a payment based on 2020 income, but didn't receive a check due to 2019 income exceeding the threshold, you can still claim this as a credit when you reconcile it on your 2021 tax return. Also important to note that if you receive a check based on 2019 income, but your 2020 income increases, the excess amount will not need to be paid back when you file your 2021 tax return. ARPA also extended the $300 weekly federal unemployment funding through September 6, 2021. Additionally, if your household income is less than $150,000, the first $10,200 of unemployment income received in 2020 is tax-free. This income threshold is actually the same for both married and single filers. However, if you're married, each spouse receiving unemployment compensation will get to exclude up to $10,200 from taxable income. The IRS has indicated that this exclusion should be reported separately from your unemployment compensation. There is a worksheet available on the IRS website to help taxpayers determine how to report this on your tax return. If you've already filed your 2020 tax return and qualify for the exclusion, the IRS has asked taxpayers not to file amended returns at this time and instead wait for additional guidance to be issued. ARPA is providing some expansions to already existing credits that are applicable to 2021. So the first one that we will discuss is the child tax credit. So the first change is that 17-year-old dependents are now considered qualifying children for this credit. Previously, the child had to be under the age of 17 in order for the parents to qualify. The second change is that the credit amount increased from $2,000 to $3,000 per child, or to $3,600 for children under the age of 6. The credit is phased out for single filers earning more than $75,000 or married filers earning more than $150,000. Lastly, the credit is going to be fully refundable for 2021, meaning you can still receive the credit even if you owe no tax. Previously, only $1,400 of the $2,000 credit was refundable. Congress has asked the IRS to set up a system to send periodic payments to taxpayers from July to December 2021 so that families can receive this credit in advance. So the goal is that the IRS would send payments monthly for a total of 6 advance payments instead of having the taxpayers claim the full amount of the credit at the end of the year when they file their 2021 tax return. For example, this would result in a family receiving $250 per child per month or $300 per child per month if the children are under 6. The IRS will use 2020 tax return information to determine eligibility or 2019 tax return information if 2020 has not been filed. Individuals will have the option to elect out of receiving the advance payments through an online portal that the IRS is developing and will release to the public. Taxpayers will also be able to update income, marital status, and number of qualifying children through this portal as well. So the next credit we will look at is the Child and Dependent Care Credit. ARPA also makes this credit fully refundable for 2021. Previously, the credit was equal to 20 to 35% of up to $3,000 of child care costs for a child under the age of 13. The amount increases to $6,000 for 2 or more dependents. For 2021, the credit is equal to a maximum of 50% of up to $8,000 of child care costs for 1 child or $16,000 for 2 or more children, making this credit worth up to $4,000 for 1 child or $8,000 for 2 or more children. The credit begins to phase out at household income levels over $125,000. For households with income over $400,000, the percentage of allowable expenses used in the credit can be reduced below 20%. And the Act also increases the exclusion for employer-provided dependent care assistance to $10,500 for 2021. So next we will talk about the Earned Income Tax Credit. This is a tax credit available to low-income individuals. It reduces taxes owed and is intended to offset living expenses and Social Security taxes paid. For 2021, ARPA expands the eligibility and the amount of the tax credit for taxpayers with no qualifying children. It reduces the minimum age to claim the credit from 25 to 19, except for full-time students. And it also eliminates the upper age limit on the credit, allowing those who are 65 and older to benefit. The phase-out percentage is increased to 15.3%, as well as increased phase-out amounts. The Earned Income Tax Credit provides a special caveat that the credit cannot be claimed if you have investment income over a certain dollar amount. ARPA increases this threshold from $2,200 to $10,000 of investment income for 2021. And lastly, ARPA allows taxpayers the option to temporarily use their 2019 earned income in the calculation instead of their 2021 earned income if it is advantageous to the taxpayer. And our last individual provision that we will discuss is the extension of the excess business loss limitation. So one of the changes made under the 2017 tax reform law was to limit the amount of business losses that a non-corporate taxpayer can deduct in a tax year to $250,000 for single filers or $500,000 for joint filers. Any disallowed loss is carried forward as a net operating loss to the following year. This limitation was set to apply to tax years 2018 through 2025. The CARES Act passed about a year ago and suspended the excess business loss limitation for tax years 2018 through 2020. So while this suspension still applies, ARPA extends the sunset date of the excess business loss limitation through December 31st, 2026, instead of ending in 2025. So now we will talk about a few of the business provisions of ARPA, and Matt will pick it up again later with some PPP and ERC information. For eligible employers who were subject to the Families First Coronavirus Response Act, in 2020, the FFCRA credits continued to be available through September 30th, 2021 under ARPA. These payroll tax credits are fully refundable. They're designed to benefit small to mid-size employers and self-employed individuals for paid sick leave and family medical leave related to coronavirus. In addition to extending the credit, ARPA also makes several changes to the credits for wages paid between April 1 and September 30th of this year. So first, the eligible wages for paid family leave are increased from $10,000 to $12,000 per employee. For self-employed individuals, the amount of days an individual can take for paid family leave is increased from 50 days to 60 days. The categories of eligible types of leave that qualify under FFCRA are expanded to include taking time off to receive the COVID-19 vaccine. And finally, the limitation on the overall number of days taken into account for paid sick leave will reset after March 31, 2021. So we will now jump into a little business and real estate industry update, and I will kick it off with qualified improvement property. So the CARES Act passed about a year ago. It provides a fix to a drafting error in the Tax Cuts and Jobs Act known as the retail glitch. TICJA essentially combined a few different categories of 15-year property. Originally, we had qualified leasehold, qualified restaurant, and qualified retail improvement property, and it combined these into one single classification called qualified improvement property. So the idea and the hope was that QIP would continue on with its 15-year life, and since property with a recovery period of 20 years or less is eligible for bonus depreciation, which currently happens to be 100%, taxpayers would be able to fully write off their qualified improvements in the first year. However, the final law included what we believe was a drafting error. It gave QIP a 39-year life, making it ineligible for bonus depreciation. So I'm sure you're asking, what exactly is qualified improvement property? So QIP is defined as non-structural improvements made to the interior portion of a non-residential building. So any enlargements to a building, any changes to the structural framework would not be considered QIP. It's also important to note that in order to qualify as QIP, the asset must be placed in service after the building is placed in service. So fortunately, in March of last year, the CARES Act was passed and provided a fix for this glitch. They retroactively applied a 15-year life to qualified improvement property placed in service in 2018 and forward. With this change being retroactive, taxpayers need to take action to make corrections on their 2018 and 2019 tax returns. Essentially, we have two options. You can amend both your 2018 and 2019 tax returns to update the depreciable life of QIP to 15 years and take the additional deductions on those respective tax returns. Or you can leave both returns as is and file a Form 3115 for a change in accounting method with your 2020 tax return and essentially catch up the depreciation all in 1 year on those assets. So I know what you're thinking. I just talked about tax rates increasing, and now you're telling me I have to accelerate my deductions into 2020. So while you do not have the option to leave QIP as 39-year life, this is actually considered an impermissible tax accounting method. You do still have the option to elect out of taking bonus depreciation on this property in conjunction with filing the 3115. So that's one option if you don't necessarily want the additional deductions in 2020 and want to defer some of that into future years. So I think you all have heard enough from me today. I will go ahead and pass it over to Matt, who will dive into a few more industry-related updates.
Thanks, Maggie. That was great stuff. To piggyback off of what Maggie talked about on the QIP, gonna dive into cost segregation studies. That's when you do a study on a building to break out property into lower class life. So non-residential property would be ordinarily 39-year property if you don't do a cost seg study. Residential will be 27 and a half. That's a long time. You know, if you're putting a building in today, a lot of us may not even see the end of that depreciation life. So accelerating that depreciation, getting that deduction is important, and it's still viable. Now, bonus is still around through 2022. Actually, it's around after that, but it starts phasing out in 2023. You know, that was one item that Maggie pointed out that the Biden was targeting. I think that would be down on the list, or if it happens, I think there would be some sort of phase out included in it, because there's some Democrats out there that say, you know, like the idea of giving growing businesses a chance to be able to deduct items up front and kind of help not pay tax and keep that money to grow. Now, are they a big fan of GE getting to be able to write off equipment from day one? Probably not. So I think there's a little bit of play in that. The other thing is, Maggie mentioned that, filing a 3115 on the QIP, that's an impermissible method, so you have to do that. On the cost segregation study, you could do a cost segregation study on a building you placed in service in 19 or 20 and wait to do the study and do the 3115 in a future year and get that benefit in a future year. I've been talking to several clients that were interested in the study, but when Biden was elected and then when the Senate flipped, they backed off it because they were concerned about tax rates in the future. So they said, as long as we have the option to do this, we're going to wait and see what happens and kind of keep that in their back pocket. Another thing that should be mentioned is that the rules are based on, bonuses based on the year that it's placed in service. So if property was placed in service in 20 and you wait till 2022 or 2023 to do the study, you're still looking at bonus rules that were in place in 20. So you're not missing out by delaying. Costs that are segregated out into lower class lives are still considered real property if it's attached to the building. So even though we're dropping them into 15, 7, 5 years, that's going to be real property when it comes time to do a like-kind exchange, or we have depreciation recapture on sales, and real property depreciation recapture has a better result than ordinary, furniture and fixtures and equipment. Another thing that's available that they made permanent is Section 179D studies. Go back. If you build a new building and it meets energy efficient standards, you can qualify for deduction that's up to $1.80 per square foot. And I think most buildings, any new building anymore, is probably going to meet these standards. The deduction reduces the basis of the building, and then you depreciate the rest of it out normally, and you could even do a cost seg on the rest of the building. So you could do 179D, get a deduction, do cost seg, and break out lower class life to be most advantageous in your cost recovery. Now on the 179D study, you cannot do a 3115 for it. That has to be on an original or amended return. So the longest you could potentially wait is 3 years, and then you're out of luck. Let's skip to the unlike kind exchanges. They are still eligible for real property. Personal property is not eligible after tax reform or TICJA. IRS issued final regulations in December of 20. So, tax reform was passed in December of 17. They've been rolling out regulations on pretty much every aspect of tax reform, and it's taken 2 to 3 years. They got around to the like-kind exchanges. Real property is defined by state and local law. So what is real property in one state may not be considered real property in another state. Applies to tangible and intangible property. There are bright light exceptions to this, no matter what the state line says. So, common stock or publicly traded securities, you cannot do a like-kind exchange on that. And I will, at this point, also bring up the fact that Maggie talked about this being one of the areas in Biden's tax plan that's would potentially be cut. In talking with professionals across the firm, they think this was more of a way to kind of needle Trump, kind of get under his skin a little bit, than really happening. And if it does, it's way down on the list. And Biden's got quite the extensive list of what he wants. So chances of this happening are probably slim. For real estate professionals, I would be more concerned about the reduction in the lifetime exclusion, because a lot of people right now are not worrying about their estate and gift tax at all. You drop it down to $3.5 million per person now, all of a sudden that really brings in a whole new population of people that could be affected. And in fact, in talking with attorneys around town and other professionals in the firm, there is an appetite to give now, so to speak. The idea is, hey, if you're planning on getting this property out of your estate anyway, let's do it now and avoid any chance of the law changing. The other big thing, I think, is the stepped up basis. And that's not just on sale of, I don't think that would just be on sale of property inherited, but a lot of times we do what's called a 754 election. If somebody buys into a partnership or passes away, and we'll see that a lot of times on real estate where we have a step up in basis and they're able to get additional deductions. If they do away with that, I think that's going to get rid of that 754 election as well. And so there would be no additional deduction. Next slide. There was, in the regulations, there was a proposed purpose test. So the IRS wanted to look at the purpose of the property. So they would bifurcate it into occupancy versus income producing. If it was occupancy, that you just occupy the building and use it, that would qualify for like-kind exchange. If it was considered income producing property, then that was not going to qualify. So let's say you have a paint booth permanently attached to a building and you're using that to paint product, or that, under those proposed rules, that would have been income producing property and would not qualify. Well, cooler heads prevailed, and IRS saw the folly of that and did away with that. So no proposed purpose test. They also have added an incidental personal property. So if you have personal property that's part of the exchange, furnitures and fixtures, that's less than 15% of the replacement property, then it actually qualifies for the like-kind exchange. So, you know, if you have an office building with furniture, fixtures, cubes, you don't have to sell that separately or try to dispose of that separately. You can include it as long as it's under that 15% of replacement property. One question I get a lot of times on like-kind exchanges is people talk about, hey, I got this piece of personal property. You know, I moved from Dallas or Denver, and I have a condo out there that's appreciated significantly, and I want to be able to take advantage of a like-kind exchange. You can't do like-kind exchange on personal property, but if you were to, say, rent that for a couple of years, you could basically convert that into a business use property that would qualify for a like-kind exchange. Also, like-kind exchange, you can meet the requirements by investing in a Delaware exchange. That's basically a mutual fund, and that allows, the only fund that allows that receipt of like-kind property. I haven't heard of anybody actually doing it, but I know some people have kind of considered it because they knew they were coming out, that was going to be tight on the window to get property replaced. So I threw that in there in the option just in case. So that could be something that could be a chosen replacement property just in case you can't find anything else. Also, and this is nothing new, but you may want to have your property owned in a TIC and then contribute to the partnership instead of the partnership owning it. That'll allow you to sell the property, and each owner can then do what they want with it. Some owners could do a like-kind exchange. Some could take the cash and run. If it's just owned by the partnership, it's one or the other. Go to the next one. Opportunity zones, as we all know, they've kind of struggled to gain traction. COVID has not helped this at all. Main thing is keep an eye on the map. Due to the census, the tracks could have changed. The map should be updated now. As Maggie said, it'll be interesting what administration does. Democrats are concerned that the money is not going to the people it was designed to go to, and that even if it does flow into those areas, then it's going to push the current residents out. So I think there's probably a high probability that they will try to do something with this. If a deal is being done in downtown or Delano, OZ might make some sense. Those are both in opportunity zones, or a large portion of it is. And then the IRS has extended time to invest in an opportunity zone to March 31st. So if you had a gain that happened after March 30th last year, and the time would have ordinarily ran out by now. Your 6 months, your 180 days. You have until March 31st. So after that, it goes back to the old rules. PPP updates. If you missed out on getting a PPP loan, you can still apply by March 31st. Companies could receive a second round of PPP money if they had one quarter in 20 that had a 25% decrease in revenue compared with 19. All other rules are consistent with the first round of PPP money. And then it should also be noted that I didn't talk about EIDLs, but the first 10,000 of that is tax exempt as well. So employee retention credit, this credit has been around since they passed the CARES Act, but nobody was paying attention to it back then because if you took a PPP, which everybody took a PPP if they could, you couldn't claim the ERC credit or the employee retention credit. The Consolidated Appropriation Act in December changed that. Now you can claim both. You just can't use PPP money to have paid for the qualifying wages of the employee retention credit. So for 20, the credit was 50% of employees' wages up to $10,000. And to qualify, your business would either be shut down by the government or have a 50% drop in revenue in a quarter of 20 compared to 19. So in talking with a lot of our clients, these situations didn't happen unless you're a doctor. We're finding a lot of the doctor's office, they were temporarily shut down. So they're qualifying. Not too many companies, no matter how bad 20 was, had a drop in revenue of 50%. Now, that said, you want to actually make sure you don't qualify because these credits can be worth a lot of money. We're seeing credits from $10,000 to $50,000 up to a couple $1 million. If you do find you qualify, you'll have to amend your prior 941 employment tax reports for the quarters, the applicable quarters. It's a payroll tax credit, not an income tax credit. So you'll have to amend, and then you'll also need to pick up that income. So if your credit was $10,000, you need to pick up that credit as income on your 20 return. For 21, it was extended for all of the year. In order to qualify, the revenue drop is now just 20% in a quarter in 21 compared to 19. The base year is always 19. You don't look at 20. The credit increased from 70% of wages per quarter per employee. So you could get potentially $7,000 per quarter per employee instead of $5,000 for the whole year. As mentioned, if you receive PPP money, you've spent that to pay for qualified wages for the employee retention credit. And with that in mind, if you do get a second round of PPP, you're going to want to spend as much of that money on the other expenses, rent, insurance, utilities, and try to fill up that 40% bucket instead of using it all for payroll. So that would leave you more payroll to utilize on the ERC. As I mentioned, if you have employees, you're going to want to look closely at both years. You're going to want to make sure you absolutely don't qualify. Go ahead. Credits, just to follow up on a few credits. New market credit, if your investment in a business in a designated low-income community, you could potentially receive funding from a community development entity, such as a bank. There's community banks that are set up that have funds anywhere from 20 million to 100 million. These areas are similar to opportunity zones, but they don't necessarily overlap. but they're low income. There's a map that designates then if you have a business in there, you can apply to those community development entities to be able to receive funds. So it's an inducement to invest in those communities. Now, if you are an investor and you invest in one of those community development funds, you get a tax credit of about 39% over 7 years. Then we have the historical rehab credit. This is a 20% credit to rehab structures that are designated by the National Park Service, and it's claimed over 5 years. If you do take advantage of this, do not do a cost segregation study on those rehab expenses. They're not compatible. You can't do both. And then they did away with the 10% credit for buildings built before 1936 as part of TICJA. So I think that is all we have for you. We're happy to field questions.
All right, so far we just have one question that has come into the chat. So the question is, while President Biden is proposing a tax increase on individuals earning $400,000 or more, is there a reduction in deductions for those earning less than $400,000? Maggie, got an answer for that one?
Sure, yeah. So there is no rate deduction planned for individuals with incomes below $400,000. I think where they're going to see taxes decrease is from the additional credits and things like that. So no rate decreases other than that top, or no rate changes other than that top rate, and that's going to go up. So.
All right, so if you have any more questions, definitely feel free to put them in the chat. We can wait here a couple of minutes. Or Megan has said that if you have a question and you want to raise your hand, she can unmute you and you can just ask your question live as well if we want to go that route. Wait just a little bit here, see if we have any more questions. We did have just a question popped up here to the panelists. Will this PowerPoint be available to review later? Yeah, we can send out a PDF of that. Kristen, do you have a way that you can send that out to all the members?
Yeah, we have a YouTube channel, so we may be able to just post it on that, and then we can add a link on our social media for that also, as well. And I can talk to David Lay and see if he'd be willing to email it out as well. So, yeah.
Awesome.
Do we have any other questions or?
Looks like that is all that has popped up so far.
I would remind them about our emails that if they have questions.
Okay, I think we have another screen coming up here that we will show you Matt and Maggie's email addresses and contact information that you can always definitely ask them some questions. Let's see, we got one more that popped in here. Would you please expound on the possibility of tenant improvements being taken as 179 deductions?
So on the qualified improvement property, if that was originally designed to be eligible for bonus depreciation, so if you have that qualified improvement property in place, or you originally had put it in as 39 years, you can now go back and amend or do a accounting method change. And once you do that, then it's eligible for bonus. So no real need to do 179 on it, because you'll get 100% depreciation on that improvement property when you make that accounting method change. Or if you're adding it current, you can just take bonus, and bonus is less onerous than 179. You don't have as many hoops to jump through. So the 179 is the one thing they did add to 179 is on some structural components and that was back in tax reform. So you could actually potentially now take section 179 on, say, a new roof, or new components. It could be the whole building, but additional structural components such as those items. HVAC units qualify. Yes, HVAC, roofs, things like that. So that would be the updated 179 and bonus on those.
Just a follow up to that. So tenant improvements are able to be deducted under bonus depreciation in year one.
If they can't be in the same year, tenant improvements would have to be after the original building was in service. So if you put the building in service and do a cost seg, you could do that, and then tenant improvements after that would qualify for the 15-year treatment and bonus.
All right, looks like we don't have any more questions. So Kristen, you just want to close this out here?
Yeah, thank you all for all of that excellent information. That was really helpful to get caught up to speed on all of these recent changes in the last year. So thank you again to Matt for speaking, for Maggie, Laura, of course, and for BKD and providing all this information to us. Of course, I want to thank our sponsors again for helping us put this event together. If you have any other further questions, definitely reach out to BKD if you want to ask them some more detailed things. And then just a quick reminder about our next events. April 8th, we have the tour of the Sycamore Apartments, and then we will have the new baseball stadium tour after that. So look forward to those. Hope to see you all soon, and thank you for joining us. See you guys later.